Hey everyone, me Kevin here, coming to you with a shirt straight out from Barrows and a sponsor from MooMoo. But in this video, we've got to look a little bit closer at what's going on with retail investors. First, I want to start with retail capitulation. Now, there are many different measures of retail capitulation. We've been tracking a couple of these. Some reports by, for example, JP Morgan suggest that retail has started capitulating. However, reports by VandaTrack suggest the opposite, that retail is buying less but not quite capitulating. However, there is a clear trend that I think is worth paying attention to. And one is that retail, yes, is buying less. They are buying fewer stocks. So you are seeing this inflection point to the downside as potentially we hit closer to the bottom of the market. But retail is doing something very interesting, and it has to do with buying the dip in very certain stocks. And I'm going to talk about exactly those in this video. We'll also talk about what retail's response has been relative to institutions and also bonds. So we'll talk about all of that in this video. First, though, it's worth noting the amount of pain that retail is enduring. Here is a chart of the pain retail has endured. In 2018, retail briefly endured a Fed tightening period here with a decline in stocks of up to about 25% for a very, very short period of time in December of 2018. This was the Fed tightening period during the time which we were talking about, well, Donald Trump at least was talking about and mainstream media was talking about, this idea that, Jerome Powell should be fired for hiking interest rates. And it really wasn't until Jerome Powell U-turned around December 18th to the 22nd of 2018 that stocks started recovering. And so what we notice is retail actually then had to deal with a larger decline, about a 28% decline here during the COVID-19 crash. And folks, look at the pain we're dealing with relative to these prior pain periods. Look at what we're dealing with now. Not only are we dealing with pain that is in excess of a portfolio drawdown of between 30 to 35%. So let me make that clear. If your portfolio is down 30 to 35%, you're just normal. You are a normal investor in this environment. Look, there are some of us who have outperformed, there are some of us who have underperformed, but the average is just bad, okay? It's not great. Nobody's bragging about their stock portfolio really in 2022, with the exception of the anomalies, which generally the anomalies, to make yourself feel better, suck all of the other years. They suck 9 out of 10 years, and they do great 1 out of 10 years, okay? Because they're always making these crazy YOLO bets. But anyway, the amount of pain we're suffering is so much larger than we actually had in the last two periods of pain, the 2018 tightening cycle and the COVID pandemic, where we really had that V-shaped recovery, right? So that's quite interesting to pay attention to. But not only that, let's take a look at inflows. Now, what's really fascinating about this particular chart is it shows the resilience of retail. It shows us that the S&P 500 hit relative high levels over here at the end of July before the Jackson Hole Symposium, where Jerome Powell really talked about this continuation of tightening and really drove the market right back down, because that seems to be their goal, reduce our wealth, right? But what's phenomenal is when we get over here, yeah, you see these green bars here, these that I'm sort of highlighting right now, those are retail inflows into the market. And you'll notice, at least according to VandaTrack, they have not been negative. They've been close. They were very, very close here. They were very, very close here. But according to VandaTrack, we've actually not turned negative. Now, others have reported that we have turned negative. But what's remarkable is when you see these larger drawdowns, see this drawdown right here? Look at that sharp drawdown. Look at those inflows. Look at that drawdown right here on the left. Look at those inflows. Look at this drawdown right here. Look at those inflows. My point is, when we see this market turn down, retail is doing what they should be doing. And that, in my opinion, is actually something to be proud of. It's buying the dip. Now, buying the dip has been a painful strategy if you started back in January. It would have been better for you to just sit on the sideline for as long as possible, whether you sat on the sideline for 2 months, or 3 months, or 4 months, or 5 months, or 6 months. The more you sat on the sidelines, the better. But generally, we look back at buying the dip and we're like, damn, you probably own a lot more shares today than you owned last year. And how do you think that's going to pay out in the next 5 years? Personally, I'm very, very optimistic about that. But I will say it's not just retail becoming optimistic. Take a look at this. This is a chart right here that shows you the change in sentiment. Okay, I'm going to ignore the discussion about how this is a puts premium chart. We're going to talk about this as a change of direction in institutional versus retail, sentiment-wise, okay? Retail is this green stuff over here. This is basically how much money we're spending on puts, okay? It's been kind of stable. Hey, we were near zero here, but we've kind of been stable, bobbing around this sort of line over here, right? The point here, though, is to notice this inflection here. Institutional investors are reducing the amount of money they're spending on shorting to the downside. In other words, institutional is becoming more bullish. That doesn't mean they're right. Look, they became more bullish in March when the Federal Reserve had the FOMC meeting. That really led to a rally. They became more bullish in June before the Jackson Hole Symposium, right? And during the times that institutions become more bullish, like here and here, we could see that the S&P 500 goes up here and here. So we actually get increases when institutions become more bullish. That's roughly what we're seeing here and here. We're seeing that same sort of bullishness come back. It's not so much retail pessimism that actually drives the market lower. It's institutional pessimism that drives the market lower, and institutional turns to bullishness that drives the market higher. But the point is, through and through, retail is buying the dip. Now, I want to talk about specific stocks that retail is buying. But first, a message from our sponsor, and the bar down below will have a little indication in terms of how long that sponsor is. But before we get into the next part, I want to thank today's sponsor, MooMoo. MooMoo is an advanced one-stop trading app that makes it easy for traders to do any and everything that you need. One of the main reasons MooMoo is amazing over other platforms is because they offer the ability to trade globally, meaning I could trade in Hong Kong and the US markets all from the same platform, no logging into other platforms. What a headache. MooMoo also offers industrial chains which provide a detailed picture of trending industries like semiconductors or EVs. And I don't like headaches, that's why I like MooMoo, keeping things simple. They give you access to heat maps as well, so you can easily visualize trends from the entire market at a single time. And trust me when I say these types of visualizations offered by MooMoo make understanding market trends so much quicker. MooMoo also gives you real-time quotes, so you can be sure the price you're seeing is an up-to-date one. This feature is especially useful when you want to make sure you have up-to-date pricing. Again, earnings, foreign markets, you name it, you want up-to-date pricing. And after hours is a great time to have up-to-date pricing. It also helps you predict open market direction and allows you to act quickly on news that occurs when the exchange is closed. So sign up via my link down below, open a new MooMoo trading account, and get $10 cash back for every $100 deposit that you make, up to $50 totally for free. Use the link down below. Welcome back. So let's take a look at this. Retail purchases on a 21-day moving averages and millions of dollars. And this is only the chart of FANG MT. Now the T is debated as to whether the T is Tesla or Twitter, but the others are relatively clear. FANG MT is generally deemed to be Facebook, Apple, Amazon, Netflix, Google, Microsoft, and Twitter. It's generally what we have. But Twitter's getting delisted, so it's kind of going to screw this up. But the point is, look at the FANG MT purchases. We had a spike here in the summer for these mega cap names, Amazon, Apple, Facebook, Netflix. Look at the recent spike though, here really in August and September. Folks in the retail community are convinced that FANG is the future. Now, I personally really dislike Facebook. I even said that after before their last earnings call. I've never been a big fan of Facebook. We talk about this in the course member live streams. Remember, if you join any of the programs linked down below, you get access to our daily live streams. And we're launching a new program. It's the conversion of the Wealth Path course into the Elite Hustlers course. That'll be launched in November. But if you want to get the best price in any of the other programs, make sure you use that Halloween coupon below. But folks, to me, this is not terribly wrong. I'm a big fan of some of these big names with the exception of Facebook. I'm a big fan of Apple. I think they grow margins, and not only do they grow margins, but they also grow sales in contrast with what's actually happening in a broader PC market. Sure, services and iPhone sales are down, sure. But we knew that. Google reported that as well in the Play Store, and weakness in the smartphone sector has been known for a long time. Now, when it comes to Google, sure, we're going to see weakness in advertising, and we've got too many people at Google. They took too long to respond to this recession. But these are names, even Amazon, that are going to be with us for a long time in the future, especially Microsoft. Now, I'm not the biggest fan that margins at Amazon are declining as they reduce some of their prices to make sure they can hold on to more of their customers. Microsoft is probably going to have to deal with some of that as well within their cloud business. But these are the power players. And again, it's a sign that retail continues to trust equities. When the big names have inflows, equities are still trusted. What else do we have though? Well, we have to talk about this. This one is specifically Netflix. Netflix purchases. So Netflix purchases. Netflix isn't one that I'm super excited about. However, I will say they've returned to growth and they've actually impressed pretty decently. Just in the last 2 weeks, Netflix has increased 32% in its share price. It's gained about $67 worth of share price. And in the summer, come May and June, these folks were trading for about $187. Now they're trading for nearly $300 per share. A huge movement in Netflix. And the bulk of the purchases from retail here happen to be in the October month. And I'll tell you, Netflix has been rocketing in October. Now, hopefully retail has been able to enjoy some of that 30% gain that we've had since the bottom, October 11th, the recent bottom, or the summer bottom in the 160s and 180s. But again, this is a reiteration that retail is confident in equities for the long term. That's bullish. Here's another chart. This is a chart that shows us retail purchases of bond ETFs. Now, this is an interesting one because what you'll actually find is that retail purchases of bond ETFs were at high levels over here in August when stocks were at higher levels. Remember, we kind of rallied in August as treasury yields fell and mortgage rates fell, and then we kind of hit a wall once that Jackson Hole Symposium happened in September. That Jackson Hole meeting from Jerome Powell, that, let's just say, it hurt. And that came right at the end of 2020, or August 2022. That was on August 26th. And that's kind of right, if we kind of mark on August 26th, let's go ahead and do that. We'll go ahead and draw up from the 26th right here. Look at that. That's peak retail buying. And that's all of a sudden when the bond ETFs started falling and retail fell out of favor. Now, some people say that, well, retail just got excited because the prices of these bond ETFs were going up. But then again, we had a feeling that potentially we had reached peak yields, and we hadn't yet. Because, for example, if you jump over now to the CNBC yield tracker, just go to the CNBC 10-year yield tracker, and go ahead and pop over to, oh, I don't know, let's go to 3-month over here, because that'll show us August. The yields were super low over here in August, but they just came off of a high. I'll go out to the 6-month, and you'll see that trough. See that trough here in August? Retail thought that's it. We hit peak yields. And so why not buy the bond ETFs then? So they were actually thinking buy the dip. We peaked out with yields. Now bonds rally. They were just too early. But now, folks, now we're starting to get the thought again that did we just hit peak yields? Remember those GDP numbers that we just got this morning showed cooling inflation. Everybody's looking for signs of cooling inflation. And boy, those GDP numbers were exciting. Now, I want to go through some specific stocks as well. Look at the retail net purchases on a 5-day period here in millions, okay? Look at what retail is buying. The biggest by far in terms of retail purchases, Tesla, by a factor of 2x Amazon. Meta coming in after that. I highly think that's a mistake. I think that VR and augmented reality is 20 years too early. The metaverse is 20 years too early. Nvidia, big fan of this. Big fan of Tesla. Big fan of Apple. Netflix. You know, I'm moderate on that. I'm not the biggest fan here. I'm actually a bigger fan of Disney myself. AMD, big fan. Big fan, absolutely. Alibaba. Okay, this is another thing. VandaTrack is telling us that Chinese ADRs are being bought heavy on the dip. You've got NIO over here as well. I personally think that's a mistake. I would rather buy Taiwan Semiconductors right here. Much rather. They have less exposure to China, and I'd much rather be in TSMC for artificial intelligence chips and just chips in general than I would want to be in, you know, the consumer sector for Chinese. Absolutely not. Not with that housing collapse are going in. We could see a 10-year period of pain for the Chinese consumer. And ADRs are something that have a delisting risk. They have auditing risk. They're just something that I really don't want to touch. You know, if you want a dividend stock here, you've got AT&T, you've got Chevron, you've got Coca-Cola, which smashed earnings, you've got Intel, which had okay earnings today. Occidental is really a Warren Buffett, you know, shoulders play following the leadership of Warren Buffett. Fine. Shopify actually surprised really nicely today, though I have to say their earnings call just straight up sucked. We went through it with course members, and the earnings call was not good. It was not very insightful. If anything, the executives were really trying to dodge the fact that their margins are suffering and their growth just isn't the way it was. So we'll see. You've even got Nike in here. Anyway, these are some interesting stats to pay attention to just to see some of the behavior by retail. So, hey, if you found this helpful, check out the links down below for building your wealth. Thank you to MooMoo for sponsoring. And folks, we'll see you in the next video. Good luck, everyone. Goodbye.